In this video, we're going to peek under the covers of the S&P 500 index. We're going to look at some of what we call market internals. Think of this like vital signs of health. When you visit a doctor, they check your vitals first. Your temperature, your blood pressure, things like that. You may look fine, but your vital signs may suggest symptoms of potential problems. The S&P 500 is made up of the 500 largest companies on the U.S. exchanges. So actually, it's the individual components of the index that we need to study. The first market internal that we consider is how many stocks are above their 200-day moving average. Before we look at this number for the index, let's look at what it means to an individual stock. The 200-day moving average means the average price of the past 200 trading sessions. After each session completes, a new close is added to the average, and the first one, 200 sessions ago, is dropped off. This makes it a moving average. This is an important measure of strength. Let's look at Facebook as an example. There are two reasons I chose Facebook for this. First, we can see the entire lifespan of the stock since it's only been listed on the exchanges since 2012. So we can see the relationship of the price to its 200-day moving average. A stock in a strong bullish trend will remain above its 200-day moving average. You see that Facebook, after a bit of a rocky start, has trended above its 200-day moving average its whole life. That is until recently. You notice the price has dropped below the 200-day moving average. This is an indication that something has changed. The price has touched the 200-day moving average several times over the past few years, but this is the first time it has closed below the 200-day moving average and run into resistance trying to get back above that level. This is a symptom that needs to be watched. To professional money managers, this is a red flag. Maybe there will be further problems for Facebook going forward. Now, let's look at how that can be translated as a market internal to the whole S&P 500 index. Since the index is just a conglomeration of individual companies, let's see how many companies are trending above their 200-day moving average. The top pane of this chart shows the percentage of the S&P 500 stocks that are above the 200-day moving average. Right now, that number is just over 64%. Now turn that around. Over 1/3 of the 500 largest companies in this index have stock prices below their 200-day moving average. That is significant. What may be more important is the trend recently. Looking back at the beginning of this chart, you see in the lower pane the S&P 500 is trending up. At the same time, the percentage of stocks over their 200-day moving average are also moving up. This means that more and more stocks are participating in the bull move. By late August, this number reached 82%, but then something changed. Do you see it? The S&P continued to move up, but the percentage of stocks above their 200-day moving average began to trend down. We've gone from 82% down to 64%, and this is a significant change. We call that a negative divergence. The trend of the percentage of stocks above the 200-day moving average and the trend of the S&P 500 are moving in opposite directions. This could be a symptom of some weakness in the index. Now, this picture doesn't sound as rosy as all the financial news media harking Dow 20,000. You can't drive down the road looking in the rearview mirror. You need something that can help tell what's ahead. Market internals will help you see what's around the bend. In our next session, we will look at more market internals. If you want to see more, then you need to like my page and follow it too. So see you next time, and until then, stay hedged.